Hello and welcome to CIO Perspectives. I'm Sid, the co-CIO of Private Clients, Endowments, and Foundations here at Brown Advisory, and I'm joined by my co-host and co-CIO, Erika Pagel. And today we're excited to have our colleagues Eric Gordon and Alice Paik on the show. Eric is a portfolio manager on our equity team, and Alice serves as our Chief Strategic Advisory Officer. And we're going to talk about the implications of the U.S. elections on markets and policy. So once again, the pollsters got this one wrong. Interestingly, the betting markets appear to have called it more accurately. There are still some House races that have yet to be called, but it appears the election was a red sweep, with Trump winning the presidency and Republicans taking control of both the House and Senate. This control makes some of the policy and legislative impacts more real. There is still much to be learned about who the key cabinet members will be in a Trump administration to fill in the many blanks of what this new government will look like. We don't know how much of what has been said was meant for the campaign trail versus reality, but there are some potential implications we can discuss today. So with that, Erika, you want to kick us off? What's your take on the election and the impact on markets and anything else on your mind?
Thanks, Sid. It's been quite a week. The market moves have been so fast, but we've seen quick reactions following past elections. Going back a couple decades, the average performance from election day to year end was about 4%. Granted, we're already at that level of return. And in 2016, the S&P 500 rose just more than 1% the day after election. This time around, that certainty of the presidential result within 24 hours was a big boost to the market. So the question is today, what is the market pricing in? And so probably pro-growth, pro-corporations and business, from lower taxes and a higher probability of lower regulation, which both of these tend to be viewed as favorable by the market, a potential corporate tax cut to 15% from current levels of around 21%. That is causing this general pro-business euphoria right now in the market. And then lower regulation. If you look at U.S. large cap value, more than half of that index has exposure that could benefit industrials, financials, banks, energy, and real estate. And this is one of the reasons why we've seen broadening of returns so far in November. And it's also why there's been this big bounce in Bitcoin and cryptocurrencies. So today, S&P 500's up more than 5% in November, up more than 27% year to date. Valuations are stretched. We're close to that starting PE multiple that we saw back in 2000. So there's probably some pulling forward of returns based on expectations of what might lie ahead. Is this buy the rumor, sell the news? Not sure yet, but if we move higher towards year end, there could be a market reset once we know more about policies, particularly if they don't live up to market expectations. So a couple of other thoughts. What hasn't been working? Companies with large amounts of exposure to China or emerging markets, consumer names such as Nike or Estee Lauder, renewables and clean energy have been under pressure. And then some of the companies that have led the market so far this year have underperformed on a relative basis to some areas of U.S. large value. And then I know we're going to talk a lot about this today, but a few things that we're watching as we move into the coming weeks and months is changes to policies around corporate tax, immigration, energy policy, and an emphasis on traditional energy, and then, of course, tariffs. But Sid, it's really important to note that the same topics we were discussing a week ago before the election are still relevant today. So we have elevated equity valuations, we have market concentration. There's still this mismatch between what the Fed is signaling and bond market expectations. And just when you think we've made a lot of progress on inflation, potential policies that lie ahead have raised concerns about reinflation and expanding deficit. So from now until year end, there's not a lot of news. So markets could drift higher from here. We have an FOMC meeting in December. The probability of a rate cut has jumped up to about 75%. So, Sid, curious your overall thoughts on the election and the market impacts, but specifically on bonds, the 10-year Treasury yield has backed up 70 to 80 basis points since the Fed cut rates in mid-September. Would be curious what your thoughts are on fair value here, and will long-term rates move higher, and how does that impact our investments in fixed income?
Well, thanks, Erika. That was a good summary. I think a really big piece of this rally, which you mentioned since the election, is just relief. that we have a definitive outcome and the result won't be contested. The volatility index, the VIX, plummeted after the election day from 20 to 15. That's a 25% fall. Bond market implied volatility also came down by the same percentage despite a move higher in interest rates. So markets hate uncertainty, and this was a good market outcome regardless of who won. The red sweep puts a lot of legislation on the table in addition to executive policies. So in addition to the potential changes to the Inflation Reduction Act and its impact on renewable energy spending, which, as you noted, has impacted some of these stocks, this makes an extension and perhaps increase of corporate and individual tax cuts a real possibility. The tax cuts, as you noted, would be positive for growth and corporate earnings, but it leaves me with lots of questions around the deficit. The Nonpartisan Committee for a Responsible Federal Budget estimates the Trump campaign agenda would lead to a nearly $8 trillion increase in the deficit. That's their central case for the next 10 years, the total for over 10 years. That's about $800 billion a year. That's a big number, given the current deficit is $1.8 trillion. So it's a nearly 50% increase in the deficit, and basically all of that comes from his plans to extend and increase the cuts from the Tax Cuts and Jobs Act, exempting overtime income from taxes and ending taxation of Social Security benefits. So Trump suggests that tariffs could offset a lot of that, but most of the analysis that I've seen expects a much more modest offset. And we still don't know where the administration is going to end up on the size and the scope of these tariffs. Tariffs are also likely to be inflationary. By definition, they're going to raise the cost of goods from overseas. And if you add to that the uncertainty around immigration policy, Trump has suggested he might deport up to 15 million illegal immigrants. That would upend an already tight jobs market and could add to the inflationary impulses. So assuming most of those immigrants have jobs, this could be a 5 to 10% reduction of the labor force in the extreme case. Markets are right to be concerned about the impacts of a rising deficit, increasing tariffs, and immigration policy on both inflation and interest rates. So back to your question, what do we think fair value is on the 10-year Treasury? I think before the election, we were thinking that was in the 4 to 4.5% range. I would adjust that northward to more like 4.5 to 5% today, and there are certainly risks to the upside of that. Inflation expectations have increased by 0.5% since markets became convinced Trump would win. Markets have moved from expecting overnight rates would be below 3% by the end of next year to now closer to 4%. So it's a 1% move. These are big moves. Those inflation and base rate expectations can be backed right into longer-term interest rates. So with regard to the economy and earnings, this result is seen as a clear positive in the near and medium term, softening regulatory stance, potential tax cuts. Given we are already in a situation where the Fed's cutting rates and the economy appears strong, that's historically been a good setup for stock market performance, as you said. A good earnings outlook is typically good for credit as well, but I will say that for the most levered companies, this could be viewed as a negative. So if rates stay higher for longer, levered companies and properties may not get the relief they have been waiting for quite some time. So highly levered, junior, unsecured bonds and loans, they seem a bit riskier to me in light of this outcome. The last thing I'll say is it aligns with your earlier comments that markets came into this event seeming already a bit expensive, and they've gotten more so. So while the near-term outlook is positive, the longer-term outlook in terms of expected returns has gotten a bit worse. So we could be wrong in the assessment if we see, a productivity renaissance that comes from AI, or Trump somehow dramatically increases government efficiency as he hopes to. But this is all to say that I'm not looking to add more equity risk as a result of this outcome.
Sid, I think you listed a lot of the unknowns that we're facing today, and the market is just right now in this euphoria stage of what it means from a pro-business standpoint. But 2025 and actual confirmation of some of these policies will be really interesting to see how the market reacts as we go into the first quarter of the year. One quick question, Sid. We both have talked about lower regulation. How would lower regulation impact credit?
It's a great question. I mean, the expectation, I think, is that a Trump administration would eventually lead to changes in leadership at a lot of agencies. The FDIC, the Consumer Financial Protection Bureau, the FTC, the SEC, the Fed. The likely medium-term outcome that we're focused on, I think, is lower capital requirements for banks, or at least capital requirements that aren't going up, a lighter regulatory touch, and a friendlier environment for deal making. So the major impact would potentially be greater availability of credit, so more demand for loans, which could push up pricing and push down spreads. It could also be additive to overall economic growth and earnings. But I would note that more deals could lead to more negative credit events where companies are taking on increasing debt for acquisitions. So this month, spreads on high yield and investment grade bonds have both come down. Some of this could be stemming from these deregulation expectations, but I would expect it's more of an impact from excitement around economic growth and earnings related to the tax cuts and just the relief of avoiding a contested election. I'm curious, Erika, your thoughts. Small caps have been one of the best performers post-election. You think this is a sustainable move?
Yeah, talk about some big moves. So just in November alone, the Russell 2000's up more than 9%. So look, there was overly bearish views for much of the past year. Negative earnings revisions for the Russell 2000 had reached a very bearish stance early in the summer. And the asset class has truly been left behind on a relative return basis when compared to the S&P 500. However, small caps are highly rate sensitive. Lower rates are inherently positive for small caps when most of that index has floating rate debt. But this pro-America onshoring stance does bode well for these companies that don't have as much reliance as their large cap peers on international markets for sales and profits. And overall market broadening also has bode well for the asset class. Small caps have a large weight to financials, lower regulation, exactly what you were talking, would be viewed as a positive here. But the reality is, and you mentioned this, those tax cuts from the 2017 tax bill, companies back then, they were paying mid-high 20s, 30% plus an effective tax rate. For small cap companies, a lot of those tax rates have already come down. So again, there's probably some pull forward for returns within small cap right now. And the reality is where we sit, small caps have to deliver on earnings growth to support these returns. And where we sit today, Sid, you and I have talked a lot about what does this mean for corporate tax cuts. I mean, how do you think these tax cuts might impact large companies with what we know now?
Well, I think you hit it, right? There's just less juice to squeeze at this point, both smaller companies and larger companies. So the last tax cuts were big. That was a 39% top rate going to 21%. Now we're talking about 21 going to 20 or maybe 15. The effective tax rate on the S&P 500 is already around 18%, given that they're taking a little bit more advantage of tax loopholes and offshore and international structures and transfer pricing that smaller companies aren't as much of, but still only slightly higher for smaller companies at 21% for the Russell 2000. So they could stand to see more of a benefit. But again, with the smaller proposals, this seems to be a big difference between 2016. Less juice to squeeze here. So I'm not expecting nearly the impact that we saw last time.
I know we want to get to our guests and that conversation, but Sid, what does this mean for international markets and a strengthening dollar? To what extent will tariffs and renewed threats of a trade war impact the ex-US economic outlook?
Well, the US dollar has been pretty strong since the election, and perhaps this is the expectation of both higher real interest rates and better growth and more investment interest in US assets. It could also be speculation that some countries might try to devalue their currencies to offset the effect of future tariffs. It is very early. We can't really know the answer to this, but a strong US dollar is typically associated with more pain and strain in emerging markets where some companies and governments have US dollar denominated debt, and they also import US dollar denominated commodities. And both of those become more expensive. So tariffs on goods from abroad will also not be helpful for more export-led economies. As an example, I think this isn't a positive for Europe, given the potential for tariffs and 20% of their exports coming to the US. Also, the likely need for increased defense spending, given Trump's approach with NATO, et cetera, would be coming at a tough time for Europe. So on balance, I'd see this dollar strength as a modest negative for international stocks, but at the same time, valuations in these markets are quite cheap by historical standards and relative to the US. So I wouldn't be abandoning company investments or allocations there based on this news, but I think it does have an impact. Erika, maybe you could just sum up a little bit our positioning. We can't predict the durability of this post-election rally. How do you think we're doing, and how are we positioned if we see a continuation of this type of a market?
Yeah, Sid, we've been intentional about preparing for a range of potential market outcomes. So some of the positives in our positioning with what we know today is we've generally had an overweight to small cap companies. We've been emphasizing a balance between growth and value within equities. We've maintained this overweight exposure to the US and have been underweight to developed international and emerging markets. So mostly positioning to benefit from a potential further US rally, but also potentially to help us if pressure to increase NATO spending slows European growth. And that minimal exposure to China helps mitigate some of these potential effects of a trade war between the US and China. And then, despite a lot of rebalancing that we've encouraged our teams to think about with clients, most client portfolios are still underweight duration. So clearly, we're hopefully less sensitive to falling bond prices, but it also gives us an attractive entry point, as you talked about. The 10-year Treasury close at 4.3, 4.4, but moving higher. There's probably going to be another opportunity to think about doing that rebalance once again. I'd say the one other thing is we generally believe we're well positioned, but we are aware of that quality bias that many of our investment managers have. So, and being more underweight beta or higher beta. So just thinking about relative performance, and there might be periods where that higher quality within our client portfolios might underperform some of this risk on higher beta trading.
Yeah, we certainly saw that in an even more extreme fashion back in the 2016 Trump rally. Maybe that's a great opportunity to bring in Eric. Welcome, Eric. Maybe we could talk a little bit about equity market reactions the past week, and you could talk a little bit about similarities and differences from 2016 when we last saw Trump elected.
Thanks, Sid. I'm going to reiterate a lot of what you and Erika have already talked about, but try to bring in a few additional insights as well. I do think that this positive response that we've seen broadly in equity markets in the United States since the election does make sense to me, in that the outcome on November 5th was definitive, as you've already laid out. Investors do detest uncertainty, and many unknowns remain regarding policy, but the presidential result won't be contested as it was 4 years ago, and that's definitely an immediate catalyst for risk assets. In terms of the performance of the market over the last several days since the election relative to 2016, we've seen a very similar reaction. Investors, from a knee-jerk perspective, have viewed the outcome of this election very similarly to what we saw 8 years ago. And as you've mentioned, small caps have outperformed large caps, and cyclical sectors have outperformed defensive ones. Financials, industrials, consumer discretionary, to name a few, have led the way in the days following both Trump wins. So broadly speaking, the initial dispersion in performance, again, it makes sense to me. You have lower corporate and individual tax rates for longer, less regulation, including lower capital requirements for banks, and an increase in tariffs in the immediate term would benefit more domestically oriented businesses, and small caps are generally more US centric in both revenue and manufacturing footprint than larger cap companies. In addition, with less regulation comes the probability of increased M&A activity, and that could lead to a valuation uplift for smaller cap companies. So on the whole, these policies seem to be stimulative to economic growth, at least in the short term, and that's why the cyclical sectors do stand to benefit. I would caveat all of that, though, with the follow-through on policies regarding taxes, tariffs, regulation, and immigration remain unknown in terms of timing and magnitude. I'd also mention that for every administration this century, an exogenous event has forced a shift in administration's prioritization. So go back to George W. Bush. He dealt with 9/11. President Obama had the great financial crisis to contend with. Both Trump and Biden had the pandemic that they had to work with. And thus, we can't predict whether some event is going to meaningfully sway the president-elect's priorities, but it's just something to keep in the back of our minds as investors. We're trying to play out what we think is certain with humility and recognizing that there's still a great deal of uncertainty that we will have to tackle with. The Federal Reserve, as of now at least, remains independent and might have to respond to higher inflation by once again increasing short-term borrowing rates if the policies that the president-elect puts in place do accelerate inflation, which they very well could. I don't believe that market participants are looking too far ahead or asking these questions at the moment, at least related to equity markets. But at the same point, they'll need to. They'll also need to consider elevated valuation multiples. We're trading at 22 times forward earnings on the S&P 500, which is about 6 turns higher than the long-term average today. And that's against the backdrop of both elevated treasury yields and high earnings growth expectations. But again, those are not at the forefront of investor concerns with the S&P 500 eclipsing 6,000.
Eric, thanks for joining us today. I've had a lot of internal and client conversations. You've been part of a lot of those about market broadening. We saw it this summer, mostly on anticipation of a Fed pivot. But since the election, markets have continued that broadening. Do you think this is sustainable? And what are the main areas that you're watching?
Yeah, thanks, Erika. Just taking a step back there, since ChatGPT 4 was introduced back in November of 2022, it feels like forever ago, but it's only been 2 years. The market's leadership has been really, really narrow. So the S&P 500 over that time is up about 50%, but each of the Magnificent Seven stocks, which are largely mega cap tech names, have outperformed the index, with NVIDIA up a remarkable 800% and Meta up 400% as the leaders even within that group. The concepts around Gen AI have been a game changer for equity investors, as we've seen. Now, if we think about the Trump trade, the policies should inherently benefit these more cyclical sectors and smaller companies relative to the mega cap tech names. However, less regulation likely removes one of the important bear cases on this mega cap tech group, which is antitrust legislation risk. Alphabet faces a pair of Justice Department antitrust cases, one targeting its online search business, which is its golden goose, while the DOJ has another pending antitrust lawsuit against Apple. The FTC is suing Meta and Amazon. So the president-elect is likely to allow these companies to continue to compete and spend as they strive to harness the potential of Gen AI. We should also consider that if accelerated inflation is a consequence of Trump's policies, and the Fed needs to respond with higher rates that in turn slow down the economy, investors may look to quote unquote hide in the secular growers, which include, of course, the mega cap tech companies. So right now, consensus expectations for 2025 for the other sectors, the non-tech oriented sectors, are to deliver strong double-digit EPS growth. So very healthy backdrop for all the other areas of the economy. If that doesn't materialize due to macroeconomic reasons, we could find ourselves back in a narrow market leadership environment. And the caveat there is, especially if mega cap tech companies can demonstrate accelerating revenue growth from their AI investments. And we'll talk more about that for certain.
It's really interesting, Eric. You nail it. People have been hiding out in some of these mega cap tech companies because of the certainty of growth, really for the last few years, because of the concerns about broader economic growth conditions. And so Erika noted since July, people got a little bit more comfortable that the economy was doing all right and the Fed was going to cut rates. And so that allowed people to start moving away from their safe place in the big tech names. But if this growth doesn't deliver, we could see a return to that positioning. I'm curious, maybe we could pivot now to tariffs. And, we already have tariffs, but there's proposals for more tariffs, higher tariffs, tariffs on different products, maybe moving away from just focusing on China and targeted tariffs. How are companies positioned today in your observation for tariffs? And how are you just thinking about that as an equity investor?
Yeah, thanks, Sid. It's clearly very early still, and we've heard the campaign rhetoric, which might be very different or somewhat different from reality. But a sampling of companies that we've heard from in recent days suggests that on the whole, this group of US companies and European companies perhaps feel more prepared now for Trump tariffs than they were the last time around. So as examples, BMW and Honda both shared on recent earnings calls that they have large manufacturing operations in the US now relative to, say, 8 years ago. While Williams-Sonoma has reduced its imports from China from 50% to 25% in recent years. So there's still exposure. And on the retail side, there's definitely still a fair amount of exposure. But on the whole, we think the companies have responded to what occurred in 2016 to diversify their manufacturing footprint to a degree. We do think that companies that are selling into China or frankly into the EU would be subject to potentially retaliatory tariffs. And that's the second derivative of what the Trump policy could be. And it's really why the companies that are more domestic in terms of both production and consumption have generally performed well in the week since the election. Because, again, going back to this concept of the market detests uncertainty. Well, there's less uncertainty from a tariff policy perspective when you're focused on companies that are generally in-house, both from a revenue and a cost of goods standpoint.
Maybe we could then talk about opportunities that have been presented in the aftermath of this quick market reaction. We talked about overall market valuations being extended, but have there been over or under reactions in your mind or things to be taken advantage of in the last couple of weeks?
Again, it is early stages, but the market has responded with some increased volatility since the Trump win. And just, again, taking a step back, you're looking at an S&P 500 multiple that we haven't seen in a number of years. The last time that the S&P 500 was trading at 22 times forward was 2021, when the 10-year Treasury yield was only 1.5%. Today, we're nearly 300 basis points above that range. And so it's become a little harder to find bargains in the market in general across asset class. That said, we have made some changes based on the market volatility that we have seen. So, for example, we've trimmed a small cap regional bank that we've held in a couple of strategies, in large part due to the massive upward move post-election. And at the same time, we've bought a small cap consumer name that we've been following for quite a while that has sold off. And we believe that it's been overly penalized for its manufacturing footprint in China that it has been mitigating the risk of in recent years. We're also evaluating names that have been painted with a broader negative brush post-election, such as data analytics companies that are embedded in sectors such as real estate. I would also point out that Uber has traded off since the election, despite having a business model that should be viewed as pro-economic, pro-cyclical, and would benefit from the policies that stimulate the U.S. economy. However, it is viewed by some investors as the quote-unquote anti-Tesla. And given Elon Musk's intent to deliver an autonomous robotaxi to the market at some point in the future, this has been delayed for quite a while now, but I think investors still buy in to the potential that Tesla can offer in that area. So remarkably, Tesla, which is a very, very large company, it's crossed $1 trillion in market cap over the last few days, is up over 30% since election day. That move is seemingly based solely on Elon Musk's personal relationship with the president-elect. So if we're just focusing on fundamentals and we look at those two stocks in comparison, Uber is getting more attractive to us.
Eric, I'm just curious what your overall thoughts are for the tech industry and AI going forward.
Well, it's a very complex and dynamic topic when we're thinking about what could tariffs and other regulation do to the semiconductor sector. And we've heard a lot coming out of the potential administration or the Trump administration as to what could happen. And so instead of trying to forecast how that's going to play out, we think that the bigger issue really is regarding Gen AI. And it's looking at the companies that are purchasing the GPUs from the semiconductor companies. And these are businesses that are among the largest in the world. They're Alphabet, Microsoft, Amazon, Meta. Are they going to be able to see an acceleration in revenue growth to match the massive investment that we've seen over the past 2 years related to data centers and AI chips? Now, potential tariffs only increases the complexity and challenge of being to answer that question with any accuracy, but it's something that we need to be considering. So just a few details. The 4 companies that I just mentioned alone have spent nearly $60 billion in capital in the third quarter, primarily on infrastructure and hardware associated with generative AI. That's a remarkable 60% from the third quarter of 2023. Compare that to the quarterly revenue growth that this group has seen in this most recent quarter, which is 15%. That's great growth, by the way. To have top line growth of 15%, particularly for companies that are as large as these hyperscalers are, it is remarkable. And it's why these companies are viewed as some of the greatest businesses of all time. That said, when your capital spending is going up 60% and your revenue is growing 15%, what you're doing is you're likely diluting your return on capital. And that is a risk for multiple compression for these great businesses. So I think that over time, through the Trump administration, we'll need to see how tariffs play out that impact the sector as a whole. But our analysts are going to be honing in very, very closely to determine whether these companies are eventually going to be able to monetize the generative AI investments that they've made such that their revenue can accelerate. And that will help those companies' stocks continue to maintain elevated valuation multiples as we've seen in recent years.
Eric, I think it's a really good reminder that the fundamentals are going to matter the most in these companies, perhaps even more so than all the things we've been talking about previously. And I did find it interesting. We're constantly debating this AI topic. Mark Andreessen came out the other day and made some comments that had people, I would say, scratching their heads a little bit. But he mentioned that we've really slowed down in terms of the amount of improvement in these AI models. We're increasing GPUs, but we're not getting the intelligent improvements at all. And when you hear comments like that, it's just a great reminder of the uncertainty of where this is all going and the humility we need as investors.
Yeah, Sid, the narrative, when you listen to the CEOs of these great businesses on earnings call, is incredibly positive. We've got Gemini, which is the AI tool for Alphabet, has over 2 billion users right now. Meta AI has 500 million users within their ecosystem. You've seen Microsoft talk about having a $10 billion run rate in revenue for its AI-oriented business. And Amazon's AI business is growing well over 100% year over year. I mean, these are all like wonderful comments, and they continue to invest with the expectation that through their models, they're going to be able to enhance productivity and efficiency for their clients across the cloud and just around the corporate world. The challenge, however, is when we're observing the fundamentals and looking at revenue growth, which is slowing down from the mid-teens into the lower teens as we go into the fourth quarter and perhaps beyond, it just creates this disconnect, and it forces investors to remain very patient with businesses that traditionally have been fairly not capital intensive. There's been a tremendous amount of free cash flow generation. And now you run the risk of, if revenue growth is not accelerating, so second derivative here, revenue is still growing. It's just not necessarily growing at a faster pace than one might expect with all of this investment that's being made with cash on the balance sheet that could be used to buy back stock, rather than to invest where you're not necessarily seeing that return on investment. And I think that that's the skepticism, and it's healthy skepticism, that investors have. We don't know how it's going to play out yet, but comments like each incremental model is not demonstrating the amount of improvement in efficiency and speed, that is concerning if you are an investor in these mega cap companies.
Eric, speaking of uncertainty and the mismatch out there, there's a real possibility of reinflation. And how is your team thinking about this? Are companies already starting to make changes based on this? And what are the biggest risks?
Yeah, I think, Erika, we've seen the stocks of companies that are viewed as able to pass through prices. So insurance companies, some companies that are selling products in the data analytics space. Like, these are businesses that we think will be able to pass along higher prices in the event that we see a more inflationary environment. But when we think about probably the most important facet of the economy, which is the consumer's been resilient. And it's important to give the nod to the US in this regard, because the US economy has been the strongest around the world across developed markets. And it's in large part due to the health of the consumer that we've seen in a post-pandemic world. That said, as reinflation of goods and services occurs, it just means wages can't go as far. And so we've heard from a number of companies, just some cracks in the armor, if you will, where the phrase resilient maybe has gone to discerning when describing the consumer. And I would argue perhaps that discerning comment might actually be converting into caution. And I'll just provide a couple of examples where we do have some concern about the US consumer. In the third quarter, IDEXX Labs, which is a veterinary diagnostics company, said that in the past few months, wellness visits for veterinarians has declined by 3 to 4% versus the prior year. So these are visits that are primarily not covered by insurance, but it's the same effectively as humans showing a meaningful and intentional decline in obtaining physicals from their primary doctors. And in effect, that's the parallel that I would draw. Sherwin-Williams said that their auto refinish business was under pressure as repairable auto insurance claims declined nearly 10% from the prior year. So basically what that means is people can't afford to pay their car accident deductibles. And then lastly, A.O. Smith said that North American water heater volumes fell more than 4% in this most recent quarter. So I can see a consumer deferring a pet wellness visit or even deferring repair of a non-totaled vehicle. But it's hard to imagine consumers deferring the purchase of a new working water heater for their home, especially as we're moving into the colder months. Thus, to me, the greatest risk of reinflation is that the price of goods and services rise, and it puts additional pressure on more and more what we're seeing to be a relatively stressed consumer, all else equal.
Thanks, Eric. I want to now bring in Alice. You've been very patient, Alice. We greatly appreciate that. And we're excited to have you talk a little bit about some of the policy implications here. We have limited detail, but maybe you could educate us on what the elections might mean for tax policy and planning opportunities.
Yeah, thank you. Appreciate being included in this conversation today. It's been interesting to listen so far on all the market commentary. My focus before the election and now since the election has been thinking about when will, in particular, tax policy measures come into play and what will it mean to our clients and the markets overall. So one thing, just to comment that we are not quite to a place where we have a unified government system. There's still a few outstanding votes in the House of Representatives, but it's certainly looking as though that's the direction that it's going to go in. If we were to have a Democratic House and a therefore divided government, that might change a little bit of the course of what might happen in some of these policy considerations, and it certainly might change the way in which the Senate had to get to a supermajority vote of 60 votes to change tax policy versus a simple majority of 50 votes in the way that we think it's likely going to go with a unified government. So some of the policies that will expire in the next few years that are likely to be renewed are the ones that were introduced through the 2017 Tax Cuts and Jobs Act. And many of the policies that are set to expire at the end of 2025 that now we believe will be extended are very important to the individual taxpayer and their households. Things like lower income tax rates, a higher standard deduction, a larger child tax credit. For business owners, 20% deduction for income for some of those closely held businesses. And something that's been written quite a bit about is a larger exemption for estate taxes. Those were all pieces of the 2017 Tax Act that were temporary, that were set in place for 8 years and have an expiration date of December 31st, 2025. So taxpayers are watching to see if those are the ones that get extended in the coming months. There really is a lot of pressure to take action fairly quickly because taxpayers want certainty on what they should be doing and how they should be planning. As you mentioned, Sid, what will be highly debated is how to pay for all of this. I think your number, which is accurate, which is that the policies that have been proposed are likely to cost an estimated $8 trillion. That additional spending is something that may impact the economy. It certainly would affect the debt and deficit. And it's hard to know exactly where compromise will come into play and things won't get done exactly as scripted on the campaign trail. So there will certainly be a healthy negotiation around spending policies and how to pay for them.
So Maybe you could talk about how long it might take to implement change in this new administration. What's the sequence of events? What's next? And what are you expecting?
Yeah, maybe I should just take one step back because the expiring tax cuts are actually not the only thing that came up on the campaign trail. We have a couple of other items that have come in. You mentioned exempting from taxation things like tips, overtime, incomes, also Social Security benefits. A piece that was important in paying for the 2017 tax cuts was the cap on the deduction for state and local tax deductions. And our president-elect, when he was on the campaign trail, mentioned that he was interested in lifting that cap. It's a real question as to whether all of this can get done. Spending will be at issue. There are very few levers for increasing revenue, and so a lot remains to be seen. But in terms of thinking about how all of this gets done and what the procedure will be from here, assuming we have a united government where the presidency, the Senate, and the House of Representatives are all controlled by the Republican Party, we would expect that they would employ a few tools to get to their policy agenda a lot faster. Namely, we would expect that for tax policy, they would look to the budget reconciliation procedures to implement a faster, more efficient path to get to certainty for taxpayers on tax policy. The budget reconciliation process is one that is not new. We have seen it before. In fact, actually, it's what they used to pass the 2017 tax cuts. It's also what they used to pass the Inflation Reduction Act in 2022. So again, this has been a fairly common tool of administrations and Congress to streamline decision-making and get to an outcome where something actually can become law. So our expectation is that we will see a reconciliation bill proposed. It starts in the House, and it becomes a real negotiation, a real budget negotiation between the House and the Senate. They will likely, behind closed doors, set budget targets on what can be done, and then we'll start to think about what actually can get through, what's most important, where their priorities are, and how long they can hold those lower tax rates in place. As I said, the 2017 Tax Act, what we're talking about are the temporary provisions that are set to expire. I would expect that there will be some temporary provisions in the new legislation as well that will help to pay for the tax cuts that they are both extending and the newer tax cuts.
Alice, thanks for joining us. This is really important detail. One thing that probably will happen is the use of executive orders, and it'll probably happen pretty quickly. What do you believe will be the focus areas?
It's a great question. And I think I'd also comment that executive orders can't cover everything. So we just were talking about the procedure for tax policy changes. That is a legislative process. But in fact, the executive orders are quite broad. And we would expect, and there's quite a bit that's been written already in the past week about some of the areas that might get addressed through executive orders almost right away. The areas that come into conversation would be tariffs, immigration, deregulation, which may include the release of limits on energy projects, maybe some ease of regulation on the cryptocurrency industry. But for tax policy in particular, you actually have to go through Congress and the legislation is required. It's important to note that the executive order process is not unchecked. It is the judicial branch that has responsibility for ensuring that all executive orders are compliant with the Constitution. And many are suggesting, depending on the magnitude of the impact of these executive orders that we think are coming, that there could be judicial challenges.
I guess, Alice, with the legislation, right, as you say, if we've got the sunset of these tax breaks at the end of next year, Trump and his team have to get right to it. So does Congress. And so we should expect some kind of an answer probably, in mid-2025. We'll know what direction it's going and what this legislation might look like.
Looking back on the first administration for President Trump, we see that the tax legislation was introduced in early November. It was passed and signed into law by late December. I think we will see it much faster this time around. This is an administration that is interesting that it is a new president, but one that has 4 years of experience on how to get things done. It also is important that people who are planning around the expiring tax laws have time to plan. And that's going to be an increasing amount of pressure on getting things done. Our expectation would be that this is a process that gets negotiated probably over the summer, and they would hope to have this wrapped up before the Congress takes its recess at the end of August.
I would maybe add one more thing that I certainly have been reading a lot about in terms of what could happen early on in the administration. He's talked a lot about government efficiency, and there's been a lot written about the Schedule F categorization of Washington employees and making it easier to let go of DC bureaucrats. And so I think a lot of people will be watching that. Some are worried about the politicization of that, but clearly one of the ways that Trump and some of his people surrounding him suggest we might pay for it is through increased government efficiency, although most of the numbers I've seen estimating that are pretty small. Maybe, Alice, we could talk quickly just about what planning areas are you focused on for clients in light of this?
Yeah, to comment on what you just said, Sid, I think it's important to note that there are seemingly a limited number of places that revenues can come from. Taxes is a primary source. We're talking about reducing that revenue. Tariffs, we've talked a little bit about. That is certainly on the table. Reduction of spending in other areas, which would include, as you point out, the reduction of government employees and maybe even projected economic growth. Again, another theme of this call to say that if we are pro-business and pro-growth, governments have a way of calculating that and including that as future revenue that can be used to offset some of these expenses. So in terms of planning, what we're telling clients for this year, we're coming up against year end, and our clients are asking, what, if anything, should I do? With the outcome of the election, we really feel like the end of the year is sort of status quo. We believe that there will be no change to the detriment of our taxpayers for 2025, and they've got a little time to wait until they can see what the proposed changes are. Again, we don't think all of the tax cuts will get through as proposed, so that budgetary negotiation will be very important. But for those who are really thinking about income taxes, whether they're accelerating income or pushing it into the next year, a very normal path is what we're advising clients to do for this year. It's a little different for our clients who have been planning in advance of a change in the estate tax legislation, largely because that planning is more complex. Sometimes it requires setting up special entities, whether they're trusts or business corporations, to help facilitate that transfer of wealth from one generation to another, sometimes positioning assets on a balance sheet to make it as strong as they want it to be for those transfers will take time. And so we're suggesting to clients who need to form entities and have been planning to do so in advance of this tax law change to keep going. They can decide at a later date whether or not they want to fully fund those strategies next year. But it's important to note that at some point, practitioners won't be able to handle the volume and they may run out of time. So we're suggesting to people that they go ahead and they set up those entities and they're prepared. If the tax law works in their favor, they can execute those strategies over a series of years. They don't need to do it all up front, but at least they'll be prepared and they'll be ready to execute on their plans.
Thanks, Alice. That was really helpful. And I think a good reminder that planning is always good, especially well in advance, but hopefully our clients are feeling a little bit less stressed about the uncertainty and potentially big changes that were coming in estate law and income tax rates, et cetera, even if I'm sure we'll have a pretty fun 2025. Thank you, Erika. Thank you, Eric. Thank you, Alice. And thank you all for listening to this special election podcast, and we'll see you next time.